I've been looking forward to this, and I'd like to thank the stock markets for at least cooperating, giving us something of note. That's dramatic. Of course, yesterday's massive down day, both in the Toronto Stock Exchange and the Dow Jones, gives a starting point for us to bring back one of the real legends of analytical tools and analytics in Wall Street, Mr. Jim Dines, author of The Dines Letter. Jim, I appreciate so much you finding time for us. And as usual, and this is the sign of the times, there's just so much to talk about.
Hello.
Hi, Jim. Can you hear me?
Oh, now I can, yes. Mm-hmm.
Okay, sorry about that. Hey, I'm just saying it's just wonderful to get you on a day when we've had those, yesterday was the kind of day that says, hey, pay attention. We got Jim Dines coming on the air with us. You, of course, have not been a fan of what's been going on in the overall market. You've been stepping aside and saying, no, it's much more important to get into the right groups because the overall market won't give you any confidence. And I'm sure what happened yesterday certainly doesn't change your mind.
That's right. This is a critical moment in the stock market, and it's wise to pay close attention to it. Let's take a step back to the 2008 crash. At that time, I said that a deflation had just begun, so we turned bullish and we became optimistic and then remained that way for 6 long years until we finally turned pessimistic with our sell signal on December 12, 2014. And since then, the Dow Jones Industrial Average, which is, of course, the world's leading indicator, has been essentially flat, adjusted for inflation. And I'm not sure that my sell signal toward the stock market was correct. In fact, even now, the Dow is only 3.4% away from our sell signal of nearly 2 years ago. And on your show, Mike, I've been waiting for that breakout, upside or downside, and I still expect down as of today in an international bear market. Maybe we might get a little rally on Monday, but I still think the main trend will be down, which is good news for gold and silver investors. That's based on the Dines theory of gold counter trend. It's no accident that gold was up this year as general markets have been soft. And here's where the fun begins. I just went back to review my last 2 appearances with you, Mike, and anyone in the audience can pull this up on the internet to confirm it at Moneytalks website. And the big picture, my gold and silver sell signals beginning at the gold top on March 14th, 2012, began a long, bitter period. We all endured it as investors in raw materials. But then at my February 13, 2016, with you 7 months ago, I finally turned bullish on gold and silver, very optimistic. And you can check this. I said, quote, I flashed a buy signal on golds and silvers 2 weeks ago in the Dines letter, end quote. And that was 2 days before gold and silver stocks erupted this year for spectacular profits. If you'd followed me on that one, doubles, triples, and even a 4-bagger on low-price stocks such as First Majestic went from 6 to 25, and that's only since the last time I was on your show. And I tell you, I've never experienced a gold and silver rally this steep before, and I was really lucky with my timing, and I just can't do better than calling the turn within 2 days, and that's it for me. So for new buyers, you've already missed the cream of the move, and now you need to make a decision as to whether to wait for a pullback or hold your nose and dive in now. You might get half your positions now. But I'm still extremely bullish on golds and silvers. The power of the beginning of this move has a long-term meaning to me. I could get back to that. And there have been relatively few pullbacks so far this year. Why? Anybody who held those stocks through the bitter years are not eager to sell. So it's supply and demand. And that's my big picture. Bearish on the stock markets and bullish on the precious metals. And I can come back later for the short-term outlook. Mike?
Yeah, I'll come back to a couple of those things. And let me just ask you one thing here. As the markets get so focused on what the Federal Reserve is about to do, or at least the media does. And then I think, but I do think it's realistic or accurate to say that the market also looks at what that Federal Reserve, and it just one of the things, of course, with your broad background in history, just maybe correct me, but it seems like we've never seen more kind of manipulation by central banks than we're experiencing right now. And I guess I'm asking, does it make a big difference? I mean, that seems to be what Friday's short-term move is about, is they think of the tightening credit. But who knows? Can you just give us a quick perspective on the Federal Reserve and the whole central bank activity?
Sure. Well, you're right. It's because the Fed is desperate. The media has been obsessed with whether Fed head Yellen will raise interest rates or not, and the whole world follows America on that, which is terrible. And I believe it's not a path to profits. First of all, nobody seems to know for sure whether higher interest rates are good or bad for the economy. Second, why would a quarter-point interest rate change make a difference to somebody who is considering borrowing? Third, this is a political year in America. I'm skeptical any politician would do anything even remotely controversial before the November 8th election. It's in 2 months. So Fed head Yellen stalling and hinting she'll raise rates, but so far for the last 6 years, it's been all talk, no action. And the truth is, I dare to hold the entire Washington economic establishment to task for blind faith in a crackpot theory that was born in the 1930s and is not applicable to today's world. I cover this in detail in my Go book, but briefly, the economic geniuses in Washington studied the results of the crash in the 1930s, but they failed to look at the cause of the crash in the 1920s. For example, the Genoa Convention, which is almost unheard of. Now, people aren't even aware of it. Now, the Fed thinks that all they have to do is cut interest rates and print more money and go into more debt, and the world would have permanent prosperity. It's oblivious to the idea that inflations are always followed by deflations, and we're in one now. So they don't agree with me on that. As they keep trying to print more to stoke inflation, they don't even remember that inflation was the big enemy 2 years ago, and now they're lusting for it, proving they have no idea what they're doing. And it's the economists who follow Keynesian economics blindly down a path that's left America with nearly $20 trillion in debt that is unpayable. I cover that, the results, the punishment of that in my newsletter. But the Feds worldwide have finally cut interest rates to zero. Still no stimulation. And finally, the fanatics are actually cutting them to below zero, meaning that you have to pay money to lend money to your bank, which I predict will be looked back on as incomprehensible economic insanity someday. The Fed was created to eliminate depressions, such as the one in the 30s, but all they've done is postpone what I've been calling the Second Great Depression, the first tremor of which occurred in the 2008 crash, and which is why I don't pay much attention to what the Fed does with interest rates. It's the whole structure of their economic strategy that has failed and resulted in poor economic performance with a huge historic debt overhang, which should be kept in mind. Such debts usually end in tragedy, and this is not the time to be careless. In my newsletter, I recommend that everybody owns some gold and or silver coins of the type I describe. Mike?
I'm talking to Jim Dines. He's the author of the Dines Letter, which you can find at thedinesletter.com. Jim, just one quick word on that. You just happened to mention the politics. Does it make any difference really for investors who wins the presidential election?
Well, I have no idea what's going on in America's presidential politics. So my only advice to you is this, is to pray. Right?
I was talking earlier in the show about Libertarian candidate Gary Johnson being asked on television if he had a gun to his head, if he would vote Clinton or Trump. He said, "I'd let the gun go off." So there you go. Yours is a more optimistic. Just pray. Let's come back to gold just for a second here. I mean, one of the things, and it just alluded to earlier on, I looked at the recommendations that you'd made on the show and in the Dines letter going back several months. And, the ones that doubled in value were the ones that didn't perform well compared to the others, because you had triples and a quadruple in there. One of the obvious questions, and you sort of alluded to it up front, but is it too late to get in that market? Should we stand aside for a correction and maybe then look to jump in? What's some advice on that?
First of all, the size of the company in which you invest has to be a function of the number of things. It includes the quality of management and particularly the quantity of their ore picture and the chart pattern. As a general rule, the higher
room here
tend to move more sedately. and they rise more slowly. And in this category, I like Silver Wheaton and Agnico Eagle. They've been long-term favorites of mine. While the riskier low-price ones, they could double or triple quickly. And so which one to buy really depends on your own personal portfolio style, or even a mixture of both large and small stocks. And, I've been studying them my entire career as into raw materials, and I have a reasonably good sense of the narrative of the many different companies ongoing when they go in either direction. And I'll give you a quick word on both gold and silver.
Jim, just give us a quick word on maybe gold. Then I've got to take that news break, and then we'll come back and get some silver.
Mike, I had no idea you had so much power that you could cause an earthquake.
No, it's your appearance that's doing it.
Well, as the original gold bug at $35 an ounce, my target was $400, and then it got up, it surpassed that to $800. The second wave carried gold to $1,889, almost $1,900 an ounce. This, because of the power of this beginning, I think this might be the third wave I've been waiting for, which will carry toward my long-term targets of $3,000 to $5,000 an ounce. Now, nobody's ever believed me on that, but I can't allow that to influence my careful judgment. And when gold was at 35, I also recommended silver, and even those few who began to follow me into gold were negative towards silver because they claimed it was an industrial metal, then selling at 92.5 cents. But I predicted it would go to $50 an ounce, and there were people who were muttering that I should be sent to prison for such an outrageous prediction. In fact, my prediction came true, and on the second wave, I thought that it would go over $100. Now, for the coming third wave, I've been looking for $300 to $500 an ounce, believe it or not, and you can come back and listen to that prediction someday. I do for many of those. Mike?
There's so much to talk about here, and I don't want to cut us short, so I'll take a break here and come back with Jim. Now, we got a little interrupted there, so I'm going to come back and I'm going to ask him more about a little more elaboration on, I loved his point about the size of the mining company, take a look at some in the gold sector, come back. You heard those, Jim, just then saying silver as much as $300 in gold, maybe entering this third wave, that would take it up to between $3,000 and $5,000. So on my part, there's a lot to talk about with Jim Dines. I'll tell you how to get a hold of the Dines letter, though, right now. All you have to do is just go on the internet. It's thedinesletter.com, thedinesletter.com. You can get a 1-year free fair trial there. Great stuff. And one of the things we never get a chance to chat about, by the way, on the air is what an entertaining read it is, too, with information on a variety of subjects, obviously focused on the markets and the economy, et cetera, and what stocks. But great stuff with Jim Dines. We'll be back with him in just a moment on the Money Talks Network. Great to have Jim Dines with us. He's the author of the Dines Letter. You can find it at www.dinesletter.com. Coming up, I've also got Aussie Jurek and a Goofy Award, but I've got lots to talk about with Jim to get to. Jim, I'd ask you just to backtrack a little bit again about the gold mining shares, the silver mining shares. Just a quick word to summarize.
Well, do you want to know about the commodity market as a whole, or do you want to know just specific gold stocks?
Well, actually both, because, of course, the commodity markets, you were very clear with the coming deflation in 2008 that was going to be bad news for commodities. You got out of the gold stocks in 2012. And I just want to, okay, let's throw out the bigger commodity market. We've seen the move in gold. We've seen the move in silver. Is this sort of a foreshadowing of a bigger move overall with commodities?
I do. I think that this cycle of the commodity bear market is over in general, so I'm optimistic. People don't know where to put their money. They've abandoned the idea of getting any reasonably priced income, and they've pushed their money into bonds and utilities. They're up to nosebleed heights. But the one thing that always lasts is wealth in the ground, even though it's cyclical. Even when gold was being hammered down, it was only giving back around 40% of its previous long bull market. So this wave should carry up much higher than the former high. Gold is still gold, and if you've got the guts to ride it out or trying to use timing to get in and out, I think these will outperform many other areas. You see, You might recall the time that I recommended China. I became the original China bug right after Mao died. I became bullish on commodities because I knew they were going to build their infrastructure from scratch. Well, now India is going to do the same thing, and it'll be followed by Africa, which is bullish for natural resources. And on a shorter-term basis, my key perception was my sell signal on China 3 years ago because its infrastructure has pretty much been completed. They're overloaded in debt. They've been following the same crackpot economics America and Canada have, and I was predicting a crash there. I'm still alone in the world on that. Nobody believes my pessimism on China. That's okay. I'm used to it. I also think that'll be led on the downside by its bank and real estate sectors. So that's probably why natural resources were hammered down in recent years. But now I see India building its infrastructure, and I think these golds are beginning to move up because of that. In terms of specifics, I said before that there are blue chips. You have the silver wheaten. We recommend that at $13. It only doubled, and Agnico Eagle is only up 47% from our recommendation. On the lower price ones, and the middle ground is Silver Standard. We recommend that on March 4th at $2.84, and that's up 331%. We recommended Midas Gold is a nice one at 26 cents on March 16th of this year, and that's up 139% so far. It's 88 cents now, and I think we're grading that buy on pullbacks. And Mill Rock Resources is a new one. We added that in August at 39 cents. It's still around there. I still like that one. So there's a range of stocks to buy. You need to figure out what quality and risk you can afford to take.
Let me just change gears just for a second, a different area of the market, because you are a pioneer in this area also, and that's the marijuana legalization opportunities that would create in the investment market. Excuse me. Can you give us just a quick overview there?
Sure. Medical marijuana is, to me, the next new big bull market. Canada is going to be one of the leaders in it. And I figured 2 years ago that the American election would have several states voting to legalize medical marijuana, including California. So stockpots would get a big play. However, 2 years ago was too early for what I described at the time as a probing attack, a military term, means using a small patrol. And it was very useful to me because I began to get a beat on which companies I liked in this brand new field. You see, it's always very hard to get into a new bull market because who really knows which ones the big gainers are going to be. I picked Amazon in 1998, but I missed a couple of kids in the garage that became Microsoft. So
yes.
I've got a list of 8 to buy, and 7 of the 8 are up so far, which is phenomenal for a brand new bull market. But I'm still going to be pruning and adding to newer ones as investments emerge, and several of them are in Canada, and I hope they don't go up in smoke.
Well, that's one of the great reasons to subscribe to the Dines letter. I mean, obviously, you've got a brilliant track record in identifying nascent bull markets, and then you sift through what's going on out there, and then you try and figure out who's going to be the market leader, and that's a big challenge also, after you've chosen what's about to be hot. And this will be no different in this one. But I think it's a fascinating area, and as you say, it's explosive. We'll get more news coming up in the November election. Jim, I want to thank you for finding time for us today. I've kept you a little longer, but as always, it's been absolutely fascinating.
You're welcome. It's always a pleasure being on your show. I've always had fun with you. You're a good reporter. Great reporter.
Great stuff. Thanks, Jim. You can find more on the Dines letter by going to www.thedinesletter.com.